Alright, if you're watching this right now, don't click away. Something just happened in silver that almost never happens. And if you care about markets, if you care about risk, if you care about protecting capital, you need to understand this. In the last 24 hours, silver dropped roughly 21.5%. That's a fall from around $120 an ounce to about 97. Let that sink in. About $1.4 trillion in paper value vanished in a single day. And here's the part that matters. This wasn't normal selling, and it definitely wasn't because people suddenly stopped wanting physical silver. Both futures market data and physical premium reports are confirming the same thing right now. Stay with me because I'm going to show you what actually caused this, how to recognize it next time, and why moments like this usually matter more than people realize in real time. Before I explain what caused this move, let me teach you something most people never really learn about commodity markets. Price is not demand. I'm going to say that again. Price is not demand. Price is the marginal trade under the most pressure. Think of markets like a crowded theater. Everything looks calm until someone yells fire, and suddenly it's not about whether the play is good. It's about who needs to get out first. In leveraged markets, price moves aren't driven by long-term beliefs in moments like this. They're driven by forced behavior. Futures traders don't always sell because they want to. They sell because they have to. And once you understand that difference, you stop panicking and you start observing. You start asking different questions. Not why did people lose faith, but who was forced to exit, and what does that mean for what comes next? If this is making sense, drop a comment below and let me know you're following along. This distinction is everything. Now here's what's actually happening. Let me break down the sequence in plain language. Silver went parabolic. That rally wasn't just enthusiastic buying, it was leverage stacking on top of leverage. Futures contracts, options, margin accounts, all building higher and higher exposure as price kept going up. That works until it doesn't. When silver slipped below key intraday levels, margin calls started firing. That's automatic. No emotion, just math. Accounts that didn't have enough collateral were forced to liquidate positions. Those liquidations pushed price lower, which triggered more margin calls, which caused more selling. That's the cascade, and you've probably heard that term before, but here's what it really means. It means the market becomes self-feeding on the downside. Each wave of selling creates the conditions for the next wave. It's mechanical, it's relentless, and it doesn't care about your thesis. Here's what's wild about this. None of it requires anyone to change their mind about silver. When forced selling hits, the market becomes a trapdoor. Belief doesn't matter, conviction doesn't matter. Only margin requirements matter. And here's the part you should pay attention to, the part most people miss. Physical demand didn't collapse. In fact, in parts of Asia, premiums are still elevated right now. That divergence between paper liquidation and physical stability is not random. It's a signal. It tells you the selling pressure was structural, not fundamental. It tells you this move was about position unwinding, not about confidence leaving the asset itself. Let me layer in what else is happening behind the scenes. You've got algorithmic trading systems that react to volatility spikes. When price drops fast, these systems automatically go short or exit long positions. That adds fuel. Then you've got stop-loss orders sitting just below round numbers, $95, $90. When price blows through those levels, it triggers mechanical selling that has nothing to do with analysis. And on top of that, you've got retail traders who bought near the top using margin, watching their accounts get liquidated in real time. Every one of these layers compounds the move. The combination creates what looks like total collapse, but what it really is forced unwinding under time pressure. Now let me show you what very few people are talking about right now. When you see this kind of vertical drop in a commodity market, there's usually a liquidity crunch happening somewhere in the background. Maybe it's a large fund that had concentrated exposure and needed to raise cash fast. Maybe it's a counterparty issue where someone couldn't meet obligations. We don't always know the exact trigger, but we know the pattern. And the pattern is this. When leverage unwinds violently in one asset, it often means someone, somewhere, needed to reduce exposure across the board. That's how contagion works. Not because fundamentals changed everywhere at once, but because margin calls don't discriminate. This is the exact same playbook we've seen before. Go back to 2008. Go back to 2011, go back to March of 2020. Every time you see a violent vertical drop driven by leverage unwinds, it shows up near inflection points, not at the end of long-term stories. In 2008, oil went from $147 to $33 in a matter of months. Was that because oil stopped being useful? No, it was because levered positions had to close. In March 2020, gold dropped 14% in a week while the world was panicking about a pandemic. Gold, the safe haven asset. Why? Margin calls, liquidity needs, the same mechanical forces. And in every one of those cases, what happened after the flush? Stabilization, volatility compression, and then price discovery on the other side. Zoom out and you see the pattern. First comes a parabolic move that gets everyone excited. Then comes a brutal flush that convinces everyone the asset is broken. Then comes volatility compression where nothing happens for a while. And only after that does real price discovery begin again. We've seen this movie before. The larger story here isn't about one bad day. It's about where we are in the cycle of leverage versus fundamentals. And right now, we're in the flush phase. That doesn't mean it's over, but it does mean the nature of the move has shifted from speculation-driven to liquidation-driven. Now let me be skeptical for a moment because you should be too. Could this keep going lower? Of course it could. Could there be more forced selling if we break below $95? Absolutely. Markets don't owe you a bounce just because something dropped hard. And here's the thing about manipulation claims. Yes, paper markets can exaggerate moves. Yes, there are large players who can influence short-term price action. But focusing on villains doesn't help you manage risk. What helps you is understanding structure. What helps you is recognizing when a move is driven by forced behavior versus sentiment change. Focus on what you can control. Position size, time horizon, and confirmation. Not outrage, not conspiracy theories, not hoping someone will rescue your position. There are probably 3 types of people watching this right now. The first type already sold. Maybe not because you wanted to, but because you had to. If that's you, don't beat yourself up. Forced decisions happen in leverage markets. The lesson isn't about intelligence, it's about exposure management. If you were over-leveraged, this is the market teaching you about position sizing. It's painful, but it's not personal. Take the lesson, not the shame. The second type is holding and feeling sick to your stomach right now. If that's you, your real question isn't, will it bounce tomorrow? It's, why did I own this in the first place? If your time horizon is long and your thesis was fundamental, a 20% paper flush didn't invalidate it. Nothing about global monetary policy changed in the last 24 hours. Nothing about supply and demand fundamentals shifted overnight. If you bought silver because you believe in long-term debasement of fiat currency, that story is still intact. But if you bought it because it was going up and everyone was talking about it, then yeah, this is when you find out what you actually believed. Ask yourself honestly, did you own an asset or did you own momentum? There's no wrong answer, but you need to know which one it was. The third type is watching with cash, thinking about buying. And if that's you, patience is your edge right now. Let the market prove it's done panicking. Let volatility settle. Let forced sellers finish exiting. The best entries don't come when the knife is still falling. They come when price stabilizes, when volume dries up, when the market shows you it's absorbed the shock. Wait for confirmation. So here's what I want you to answer in the comments. Which type are you? And what's your biggest question right now? Because understanding where you are in this process changes how you should think about the next move. Across all 3 groups, the universal rule is the same. Don't confuse volatility with information. A 20% move in a day tells you about position structure, not about the underlying story. So here's where I stand. I'm not euphoric and I'm not fearful. I'm observant. Let me tell you what I'm personally watching. First, I'm watching the $95 to $100 zone for stabilization. If silver can hold above that range for a few days without making new lows, that tells me forced selling has run its course. If it breaks below 95 with conviction, that tells me there's another leg of unwinding still to come. Second, I'm watching volatility itself. When you see wild intraday swings start to compress, when the range starts to tighten, that's your signal that the mechanical phase is ending. Calm after chaos is when real buyers and sellers show up. Third, I'm monitoring physical premiums, especially in Asia and Europe. When paper cracks and physical holds, repricing tends to follow. That divergence is not just noise. It's information about where real demand sits versus where paper positioning was. Based on my analysis, this move was mechanical, not emotional. The fundamental picture didn't change by 20% in a day. Central banks didn't suddenly announce they're backing currencies with silver. Industrial demand didn't vanish overnight. What changed was leverage. What changed was margin requirements. What changed was forced position closure under time constraints. Those are technical factors, not fundamental ones. And technical factors create dislocations that revert once the pressure subsides. If history rhymes and silver finds support in the mid-90s, the move that follows could be significant, not because of hype, but because forced sellers create the conditions for short covering and value buyers to step in. I'm not predicting a V-shaped recovery. I'm saying the setup after a liquidation event often looks very different than people expect in the moment. The crowd that got flushed out isn't coming back quickly, but the crowd that understands the difference between paper volatility and physical fundamentals, they're paying attention right now. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the futures data. Look at physical premiums yourself. Ask questions. Think critically. Your capital, your decisions, your responsibility. If you made it this far, You're thinking differently than most people right now. While others are panicking or celebrating, you're analyzing. That mentality will serve you well, not just in this situation, but in every market cycle you face going forward. If this breakdown helped you see the structure behind the chaos, share it with someone who needs to hear it. Subscribe if you want more analysis like this when markets move. And stay sharp, because these moments separate the observers from the reactors. Stay sharp out there.